It's time for Yahoo Finance's Market Minute. Stocks climbing after Monday's sell-off. Investors seeking more clarity on the outlook for trade policy. Tesla shares higher following Monday's tech rout. The company releasing its first quarter earnings after the close, set to be the next big test for investors. Tesla will be the first major automaker and first Mag 7 name to release results amid the trade war. Verizon shares turning positive after falling earlier in the session. The company losing more wireless subscribers than expected in its first quarter. Price hikes as well as increased promotion from its competitors weighing on the telecom giant. And GE Aerospace shares popping as the company says it will offset increased costs from tariffs with price hikes and cost controls. The company reaffirming its full-year earnings guidance. And that is your Yahoo Finance Market Minute for this morning. For more on what's trending on Yahoo Finance, you can scan the QR code below where you can track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. One portfolio manager describes why earnings season is growing more critical by the hour for investors. And the dollar is tumbling to multi-year lows. We will break down 3 ways a weak dollar impacts your wallet. Plus, all week on Wealth, we're bringing you a guide to financial products. Everything you need to know about opening different accounts, CDs, debit, and credit cards. Today, we focus on helping you open up a high-yield savings account. You don't want to miss that part of the show. But first, as we always do, let's take a look at some of the market action. We are 90 minutes into the trading day. Stocks, they're looking to rebound from yesterday's sell-off to begin the week. Joining me now, we've got Keith Buchanan, Globalt Investments Senior Portfolio Manager. Keith, good to see you. Earnings, they are picking up this week with more companies reporting. You say this earnings season is getting more critical by the hour. We're gonna have to wait just a little bit. I think most of the calls have wrapped by now, but once we get into this afternoon, even more, and the kickoff to those Mag 7 names with Tesla later on today. What are you going to be watching for most notably? What's a common denominator we could hear?
Well, good morning. Thanks again, Brad, for having me. We're looking at this earnings season as critical to this moment where the market is very clearly pricing in a very delicate economic condition here in the U.S. As we've seen, of course, the headlines are abound with trade policy, monetary policy, and the challenges to personnel, of course. But it's easy to lose focus on, what the market's really pricing in. It's always some forward-looking mechanism into pricing cash flow returns. And this earnings season is going to set the stage for a multiple that has come from, north of 24 times earnings on S&P 500, looking forward to down now to 20 times. And even some of those that have been hit the hardest have really bore the brunt of this major sell-off that we're right in the throes of right now. So NVIDIA, for instance, is down to 22 times, just a turn and a half more expensive than the market, the lowest premium it's had in over 10 years. So it's pricing in a very precarious situation. And this earnings season will either confirm or refute that notion that the market has that this earnings season will be a turning point in margins.
What are you expecting in guidance from companies? We've heard everything from inability to reaffirm full-year guidance with lack of visibility beyond 60 to 90 days. We've also heard ranges of guidance for 2 sets of outcomes. One, if we did see a recession, and one, if all goes according to plan for some businesses. United Airlines, that was the case there. So what are you anticipating to hear from the guidance and the outlook as companies continue to report?
Well, we've seen a wide spectrum of outcomes and expectations. We think that the confidence interval will widen as corporations have less confidence in the drivers of their business from an input cost standpoint to even demand standpoint, and even some of that guidance being pulled all together, as we've seen with a couple of corporations already this earnings season. I think it will be very fascinating to highlight the companies that reported early in the season, before a lot of the tariff conversation started, and those that report later, and how their tones are different. We've already seen some of that change and just some of the lingo that's being used on a continuous basis through these corporations and the rhetoric and tone they've had with the marketplace. So we're looking at the whole picture has changed as far as what can they have in focus and what can they not really have a lot of confidence in. And that's becoming more and more apparent as we get through this earnings season.
You mentioned NVIDIA a moment ago, Keith, and it kind of brings up this remembrance that for the way up and the rally that we had seen, of course, over the past 2 years of gains for the S&P 500 of 20% on an annual basis for both of those years, NVIDIA was the earnings poster child because it was the core thesis behind the AI trade and the semiconductor portion of that AI trade. And it was a bellwether for earnings seasons. Is there a new bellwether from how you're kind of looking across and assessing the environment right now?
So just taking a step back, how do we look at how the market's pricing earnings going forward? And valuations always are pretty closely tied with margins. What the market's telling us is that there's little confidence in the margins that the companies have made up to this point, and also that earnings have to come down. The market is talking and begging for earnings expectations to come down. Now, will they come down with the actual guidance shoot south of those expectations or come in line? That's still yet to be determined. But a name like NVIDIA has almost pretty much erased the vast majority of its premium to the marketplace. Now, if you think that the growth and margins at NVIDIA will be better than the marketplace to a degree as it was in 2022 and 2023 and 24, perhaps that's an opportunity. So we're looking a lot and really studying and understanding what valuations for the S&P 500 and those kind of, what was carried below the Mag 7 technology, other names that have outsized returns over the last couple of years, and what that means for the rest of the marketplace. We've seen a catch-up trade, if you will, from value to growth, Mag 7 to other 493, and how that continues, we think will be largely determined by expectations set this earnings season and going forward in the next earnings season. And when this recession, if it comes, how deep will it be and how wide will it encompass the next 2 or 3 quarters? All those questions will come a little more into focus this earnings season, and we think this is critical for the next 12 months of of market direction.
Keith, great to have you here with us today. Thanks so much for taking the time.
Thank you, Brad.
Now time for some of today's trending tickers. We're watching Boeing, Verizon, and 3M. Joining me now, we've got Yahoo Finance senior reporter Alexandra Canal. Alec, good to see you. First up here, we got to talk a little Boeing here on the day. Boeing announcing a more than $10 billion deal this morning. The company agreeing to sell portions of its digital aviation solutions business to private equity firm Thoma Bravo. Shares were on the move for Boeing here on the back of this deal. They're still holding onto some slight gains here, fractionally as they may be.
Yeah, and it's really a tale as old as time, right? Let's reduce our debt pile by selling off non-core assets. That's the strategy of new Boeing CEO Kelly Ortberg. Now, part of this sale does include the navigation unit Jeppesen, which Boeing acquired for $1.5 billion in 2000. And when it launched to auction last year, it looked for a price above $6 billion at that time, but did see strong interest from potential buyers. That drove the valuation higher. Now, in the background, Boeing's going to have to contend with a few issues, especially when we think about the ties to the trade war. China has reportedly forbidden its airliners from purchasing any of the company's jets. So how that translates to sales, competition, a big question mark here for Boeing. But shares are down about 9% so far this year, slightly outpacing the S&P 500. So there are certainly worse names on the street right now.
Yeah, indeed. Next up here, let's talk Verizon, reporting a larger than expected drop in subscribers during the first quarter, hit by strong competition. Still, the mobile network operator topped revenue expectations. We've been keeping close tabs on shares of Verizon here on the day, which had their own warning on a guidance basis here. As we're taking a look at shares, they're holding on to about 0.8% in a move higher right now.
Yeah, and the issue for me is that there's such a limited pool of subscribers, and you have the same big 3, big 4 carriers really fighting for that. So Verizon raised prices in January. There's been intense, aggressive promotions from carriers like AT&T, T-Mobile. So that's going to really limit the pool of subscribers that you have. And this is something that Verizon actually warned warned about heading into this print. Picking out a few pieces from the earnings call, they did say that the second quarter is off to a strong start. They just introduced a 3-year price guarantee in early April, so maybe that holds on to some of those subscribers there, and we'll have solid earnings for the current quarter. On the trade front, this was an interesting comment from Hans Vestberg, that's CEO of Verizon. He said that a small portion of Verizon's annual $18 billion CapEx spend is exposed to tariffs, just concentrated within imported wireless equipment. So that's a positive. And also interesting that they saw reductions in business wireless accounts due to the, quote, new government and their efficiency work. So perhaps a nod to the Doge layoffs there as well.
Absolutely. We've also got to talk about this last earnings story that we're continuing to track here. 3M maintaining its full year guidance, but acknowledging risks from the ongoing trade war. The maker of such household products and classroom products like Scotch tape, Post-it notes, saying tariffs could impact full year earnings by up to 40 cents per share. Shares of 3M, they are still higher by 7.5% right
now. And it's currently leading the Dow by a significant margin. And it's interesting to see a stock move higher when you're warning of these tariff risk, a hit to EPS. But 3M is this defensive play. It's a bellwether when we think about the health and state of the U.S. consumer. The fact that first quarter earnings came in above expectations, the fact that they are maintaining that guidance, albeit with some of those caveats, I think is encouraging to the everyday investor. It just shows that at least a lot of the pain that we were expecting in those first quarter results, they did not ultimately materialize. So we'll continue to watch and see what happens there. I mean, on that tariff front, they did see price increases would only partially offset any potential hit. So this is a company to just continue to keep an eye on to see what they say, because it's obviously one that investors are closely tracking.
Yeah, and I just want to clarify, especially because we're mentioning that 40 cents a share. They gave a range, but the 40 cents is the worst case scenario here. I think the range is like 20 cents to 40 cents a share of additional tariff sensitivity.
And we're hearing about that, right? We're hearing about these multiple, scenarios.
And you have to, yeah.
Yes.
That's modeling.
And it's modeling, and I think it's also good just from an investor's perspective to sort of know what the worst case is, what the best case is, and hopefully we fall somewhere in the middle, if not skew a little better than expected.
And maybe get some relief on the other side here. Thanks so much, Ali. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. The U.S. dollar is rising today, but it's near multi-year lows as global investors pull back from U.S. assets amid a slew of headwinds, primarily tariff uncertainty. So what does a weak dollar mean for American consumers? Here to break down, we've got my Morning Brief co-host, Madison Mills. Maddie, what do we know?
Well, weak dollar means that the value of the U.S. dollar has dropped compared to other currencies like the euro or the Japanese yen, and that lessens the power of the dollar, as a weak dollar buys less foreign currency than it had previously. So here's how that can hit your wallet in 3 key ways. 1, imported goods can cost more, travel to certain areas can get pricier, and gas prices can also rise. So let's kick it off with imports. When an American company buys foreign goods, it typically needs to pay in that country's currency. And this trade war has shown us just how much of our stuff is imported and purchased overseas. Electronics, clothes, even certain cars made overseas. A weaker dollar could raise those prices thanks to currency exchange rates. Let's look at an example of one of those exchange rates through our next focus here, travel. A weaker dollar can mean your vacation budget does not go as far depending on where you're going. A Paris hotel, let's say, costs 200 euros a night. If $1 equals €1, a 2-night stay costs $400 But if $1 equals 85 euro cents, you'd need $470 to cover that same stay, which is $70 more for the exact same room. Our final example is gas prices. Since oil is priced in dollars on global markets, a weaker dollar typically does mean higher fuel costs, affecting everyone from daily commuters to delivery services or even airlines. To sum it up, a weaker dollar means some things like imports, travel, and gas could cost Americans more moving forward. Brad?
All right, thank God I got my Parisian trip out of the way, Maddie, just in time. Appreciate it.
Thank you.
Coming up, rising housing costs weighing on buyers here. What are some sellers doing to help? That's next on Wealth. As rising housing costs weigh on would-be buyers' nerves, sellers are sweetening the deal with more concessions. Around 2 out of every 5 sellers offered buyers concessions during the first quarter, according to Redfin data. That's just shy of the highest level on record. Joining us now with more, we've got Daryl Fairweather, who is the Redfin chief economist. Daryl, good to see you. What do you attribute this rise to? Take us into the data.
It's all the uncertainty in both the economy and the housing market. When things change in buyers' lives or in their personal financial situation during that escrow period, that's when we see sellers start to sweeten the deal to make sure that the deal goes through. That might mean covering closing costs, buying down points on a rate, or offering to cover repairs. But all of that just makes it more likely the deal will go through and the buyer will still commit to it, even though interest rates are all over the place, the economy is all over the place. They want to make those deals happen.
And so you started to mention some of those examples of concessions. How effective are they in really making sure that the deals come to a close?
They are quite effective because they represent real savings to the buyers. Covering something like a repair or closing costs or getting the interest rate down all means that the buyer isn't having to spend as much. So it's a little bit different than a price cut. It doesn't show up in the sales price, but it is effectively giving the buyer more money.
So could you quickly define for first timers? I know I have a lot of tabs open. I haven't really pulled the trigger or saved up adequately enough for any of those tabs that are open. But for first timers out there, what's a mortgage rate buy down?
So when you go to your lender, they will offer you different types of mortgage options. And one option is to pay more at the beginning so that you have a lower mortgage payment later on. And it's called points, but basically it gets you a lower rate by just paying more upfront.
And so which metro areas in the U.S. are actually seeing some of the highest concession rates from what you've been able to analyze?
Seattle, Portland, San Diego are all at the top of the list. These are markets where there is still strong demand, but with all the uncertainty in the economy and interest rates being volatile, it is difficult for buyers. In places like Florida and Texas, we see more straight up cancellations, buyers just walking away and saying, this is too much for me. But in Seattle, buyers want to make it happen. They just need a little bit extra encouragement.
Wow. Okay. I'm a little more focused on some of those those hotter areas of the map that we were just showing a moment ago. But as we think more broadly here about the annexation and the kind of guide that the 10-year yield gives us to what mortgage rates and the fluctuations there are, as you're continuing to hear from what the administration is looking for within that 10-year rate versus what is really playing out, how are we seeing that also play out into the home buyer sentiment right now?
Well, right now we are seeing rates climbing, and part of the reason is because of, let's say, the lack of faith in the U.S. economy and our institutions. If the Federal Reserve were to lower interest rates, it actually wouldn't result in lower mortgage payments. So it would probably make mortgage rates even higher because it's a signal that the Fed isn't really doing its job of taking care of inflation. So I don't think that's going to happen. I think the Fed will keep interest rates high, and that's what the market thinks too, which is why we're seeing increases in rates right now.
What are the things that first-time home buyers who are looking across everything that we're discussing, from the possible concessions to what the interest rates influencing mortgage rates is looking like, all the way to the hotspot regions, what are the things that first-time home buyers need to mention and prioritize perhaps when they are going into the negotiations and discussions for homes?
Well, I don't think you need a PhD in economics to be a home buyer. Everything that's going on in the economy is really hard to understand, but I would focus on your personal situation. How likely do you think you are to be making as much money as you are right now this time next year, over the next 5 years? Because you need to make sure you're going to be able to make your mortgage payment, not just now, but for as long as you stay in the home. And with all the volatility in the economy, the thing I worry about is people biting off more than they can chew and wishing that they had saved more money. So definitely be cautious and just make sure you stick to your budget and think about what your personal situation is. And also play a little hardball with the sellers. Come in under asking price, ask for concessions. That's how you're going to get a little bit extra money out of those deals.
Daryl, thanks so much for taking the time breaking this down for us. Appreciate it.
Thank you.
In Washington, D.C., home showings fell 18% week over week and over 20% from a year ago, a sign that cuts to the federal workforce may be impacting the city's real estate. Joining us now to break down the trend, we've got Yahoo Finance senior reporter Claire Boston. Claire, what does this tell us about the D.C. housing market right now?
Yeah, Brad, it's very interesting times in D.C. This is not Armageddon or anything, but generally speaking, we are seeing signs there that the spring home buying season is kind of off to a slower start. So like you said, showings are down 21.5% compared to a year ago. some of that is just this past week included Easter and Passover, so the data could be a little funky there. But when I looked at the week before, they were down about 9.5% compared to a year ago. So certainly signs that foot traffic is slowing. And what I think is happening here is just a lot of kind of people are nervous. Doge is really impacting the federal government and people's ability to kind of keep jobs there. We've also got all these other factors like some people, they have to return to office, so maybe they're looking to move somewhere. That could actually help the market. And we've also got, of course, tariffs and market volatility going on. So where the DC market heads from here is kind of unknown, but right now it's looking a little slow.
What is the data? Is there clear data right now that we can look across from what's taking place within Doge to assess the corollary between how the DC market and the decline in viewings or showings is having kind of that direct relationship?
Yeah, so unfortunately, we've just got like too many different factors going on to really firmly be able to say what is Doge versus, what is the general economy. But, some of the economists that I talked to who specialize in the reason, they do say that they think that Doge is impacting the market here. One thing I was looking at is pending contracts. So that is homes going under contract. We're down around 3.5% compared to a year earlier. It's also falling kind of week over week here. And so that is just kind of showing that this housing market is not as active as it was a year ago, even though inventory is up. This was supposed to be kind of the comeback year.
This is a big drop in showings. I mean, are we seeing this show up in sales or prices yet?
Yeah, so the interesting thing is that prices are still on the rise in the DC area. But what we're also seeing is that, sellers are willing to cut their prices. We're seeing more price cuts, but also prices are up overall. So there may be a little bit of kind of buyers and sellers. They haven't kind of met yet. We're sort of out of balance right now. Buyers are cautious, sellers are very aggressive. And so that kind of meeting in the middle and that market equilibrium is something I'm really looking for, in the weeks ahead.
All right. I wonder how much people are also looking to see exactly how much the pollen level is impacting some of these sales, as you and I, as we were discussing in the break, are very much vulnerable to.
It's rough out there.
It's rough. Yeah. Claire, thanks so much for taking the time.
Thank you.
Appreciate it. Coming up, everyone, is now the time to buy an EV. We discuss with Kelly Blue Book's lead editor. Stay tuned. According to Pew Research, over 16 million middle-aged Americans are part of the sandwich generation, including a majority of people in their 40s. Now, to define, the sandwich generation cares for both their own adult children and at least one aging relative. A new study from Athene finds that those Americans are heading towards a retirement crisis. Here to break down the study, we've got Michael Downing, Athene Chief Operating Officer. Great to have you back in studio on air with us. We should note that Athene and Yahoo have shared ownership. Michael, what are some of the biggest financial stressors that are facing this demographic right now?
Yeah, so one of the more unique aspects of the sandwich generation is not only do they have to plan for their own retirement, they're dealing with an extra expense burden, potentially their parents, through extra long-term care expenses, et cetera, as well as children and even grown children at home. So instead of taking care of one family, it's almost like taking care of three families. And that can put a lot of stress on retirement. And one of the core outcomes is it's made about 75% of those individuals feel like they're off track in terms of retirement planning.
I mean, so you hit on the crux of it, because clearly this impacts your ability to save, or how quickly you are able to save towards some of those retirement targets. And how have you seen that kind of be a broader headwind to hitting those target date funds, if you will, or the number that you've set forward with your financial planner?
Right. So typically what happens then in that kind of case is that these people can start to fall behind on their savings. Because some of the savings that were going towards retirement, those are covering expenses for their loved ones, and they're considering potentially even deferring retirement or not even considering retirement at all. But there are ways that they can manage around that. There are solutions that I think this generation can really take advantage of to overcome a lot of those challenges.
And so with this, how are we continuing to see this contribute to the retirement crisis? I mean, if we kind of quantify the real impact of this, if we don't have as many in the sandwich generation that are able to get into retirement, what is the longer term ramification of that as well?
So the longer term ramification, it'll be yet another generation of retirees that doesn't have sufficient income to last a lifetime. So potentially running out of money, financial ruin.
What are your financial tips for the sandwich generation?
Yeah, so financial tips, and this is coming at it from an insurance standpoint, is a tool that is somewhat understood but underappreciated is using annuities to really embed inside a retirement planning portfolio. And annuities are often thought of just for retirees, but they're not. The best time to actually start buying them is when you, in this period, this age demographic of 40 to 60, and start building annuities into your portfolio because they provide two core elements, stability and guaranteed lifetime income. And so the analysis we've done shows that you can actually increase spending power by almost 50% with the same amount of assets. And that really can change the paradigm. So you can make your existing savings last longer and also be very comfortable they're going to last a lifetime.
With regard to those savings, a lot of people who are either in retirement or close to retirement that are going to have to start drawing upon funds that they've saved up over time, they're watching the markets. They're trying to figure out how they should be able to navigate their finances in an unsteady period right now. How are you seeing them go about that calculus for their own finances and retirement funds that they've amassed?
So one of the great solutions they have, and financial advisors can play a really strong role in this, is to, especially when they get near retirement, is use a lot of bridge insurance products to help cushion that volatility. So a very common type of tool is what's called a fixed indexed annuity. And in today's market, with a tremendous amount of volatility, what's great about these products is your principal is 100% protected. S&P goes down 5%, your principal is guaranteed. S&P goes up, you get the upside. And every year, you get to lock in that upside. So it creates an incredible amount of peace of mind in terms of preserving what is often a situation where retirees are one downturn away from running out of money. This insulates and protects against that downturn.
It's really interesting. Michael, thanks so much for sharing. Appreciate it.
You bet.
We should note that Athene and Yahoo Finance are both owned by Apollo Global Management. Coming up is now the time to buy an EV. We discuss with Kelley Blue Book's lead editor. Stay tuned. Two hours into today's trading session, and we're seeing some gains for the major averages, and I wanted to put this in a two-day contextual move for you here. We're still net lower for the past two sessions here as we're taking a look at Monday, Tuesday activity, and now we're net lower by about 0.4%. But compare that to the decline that we had seen yesterday during that activity and now, trying to erase some of that, and we'll see if it can balance each other out here, but we're trying our best across all of the major averages here as you're seeing fractional declines over both of those two trading sessions put together here, but gains across the board for the Dow, the NASDAQ, and the S&P 500 of more than 2% each. Let's dive into some of the sector activity that's really driving this here on the day as you're seeing all 11 S&P 500 sectors in positive territory right now, led by consumer discretionary and utilities. Consumer discretionary, you're seeing that up by about 2.8% here, and then additionally utilities, that's seeing a 2.3% move to the upside here. So continuing to watch that sea of green, at least within the sector activity and the bounce back that we're seeing here on the day. And the NASDAQ 100, that too, don't adjust your TV screens or your eyes, don't wipe any windshields, whatever you're doing. This is correct. All of the names in the NASDAQ 100 are in positive territory right now. And just for more proof, I'll just put this on an equal view here. Right now, we're being led by Strategy, MicroStrategy, formerly known as, and then additionally Netflix, that too, up on the day by about 7%. You've also got Tesla pushing higher by about 4.5% going into that company's earnings coming later after the close here on the day. You're seeing gains of about 4.6% as of right now. And guess what? You can stay tuned for Yahoo Finance's special coverage of Tesla's earnings today, 4 p.m. Eastern Time. You do not want to miss it. Electric vehicle prices continued to climb higher in March, rising 7% from the year prior. According to Kelley Blue Book, those data, that points come in from compared to gas-powered EVs, to gas-powered cars rather, EV prices last month were higher by nearly 25% as we see the gap between the vehicle types widen. But there are a lot of financial incentives to buy an electric vehicle. Kelley Blue Book shows the average incentive package for an EV in March was 13.3% of the average transaction price. Meanwhile, 25% tariffs on imported cars are pushing more people to consider whether they should act now. So, is now the time specifically to buy an electric vehicle? That's the big question here. With more, we've got Sean Tucker, lead editor at Kelley Blue Book. Let's just start with that question. Is now the time to buy an EV, Sean?
If you were going to car shop anyway, regardless of the tariffs, then this is a great time to buy an EV. But I am always telling people, be cautious of car shopping specifically because of the tariffs. The situation is just too volatile to say, yeah, go make a 5 or 6 figure decision right now.
And so with that in mind, what is the decision tree, the kind of checklist that people need to go through now if they are thinking about purchasing an electric vehicle?
You want to be sure that it fits into your lifestyle. I would not buy one. Americans tend to overbuy, buy too much car. We look at range, and the Department of Transportation says that the average American drives about 39 miles in a day, so every EV on the market will meet your daily needs. I would be a little cautious if I were someone who took long road trips regularly, or with hurricane season coming up, I always caution folks, I wouldn't buy one if I were in a situation where I might need to evacuate.
And so with that in mind, as we're thinking about some of the companies that are just looking across their models and their fleets and how they're pricing might also need to take into consideration what tariffs could still be on the table as they're trying to sell new fleets or as they're building them out. What are you hearing from companies and what's seeming to be effective right now in their communication to consumers?
The tariffs are taking time to really impact prices. You'll see a lot of stories indicating, oh, the tariffs kicked in April 3rd. That means every price goes up by 25% on April 3rd. That's not the case. The car pricing is very complicated. There are, the automakers sell to distributors who sell to dealers who sell to you. And at every point along that chain, there's a little bit of flexibility to absorb some of the tariff. And we expect that prices will continue to shift throughout based on inventory levels. So there's not really a single predictable response yet.
And so if customers, if buyers are going to a dealership or looking to purchase online and they hear some of these advertisements saying, hey, these are tariff-free vehicles that you're seeing on your screen right now, what are the questions they should be asking when they go into a dealership or have conversation with any salesperson?
Right now, there aren't really tariff-specific questions. The issue of tariff-free vehicles is that most of the cars on dealer lots today were imported at pre-tariff prices, and they can still sell it to you at something like a pre-tariff price. However, if you are the dealer, you know that for every car you sell right now, you're going to have to pay more to replace it. So it is fair for them to negotiate a little bit of a higher price in order to be ready for that world.
And so what about on the standard and internal combustion engine that has really been the driver for markets that EVs are still trying to take some of that share from?
In terms of tariffs, there's not really a major difference between the two at this point. It's a matter of, can you negotiate that price down and would you be satisfied with the driving experience of an EV?
Certainly. And as we're thinking about where there are different commitments from companies to try and build out even more of their manufacturing footprint, sensing, and they've really kind of also been able to look across what was taking place within USMCA and Trump 1.0 to really understand, okay, where do we need to kind of onshore more of our production to avert any of these impacts in the future? Are we seeing that at full force right now, or are we expecting that there will be more announcements and more reshoring of some of those efforts?
We are seeing a little bit of it, but I would caution you to keep in mind that those are extremely long-term decisions for automakers. They're redesigning cars on a 7 to 10 year cycle. If they're building a new factory, they have to amortize that over 50 years or more. So they make very few decisions with a time horizon as short as one presidency. And also keep in mind that under the Biden administration previously, we were already seeing a lot of onshoring going on because of the EV tax credits, which only really apply to cars with an increasing percentage made in America. So the onshoring was already happening, and while it will happen, it will be a lot slower than one presidency.
Sean, thanks so much for taking the time here with us today. We know you'll be watching Tesla's earnings, as we all will be later on today.
Yes, I will. Good to be with you. Thank you.
Thank you. Coming up, we have your bank products playbook. Today, we give you everything that you need to know about high-yield savings accounts. That's next on Wealth. The U.S. Department of Education announcing it will begin collections of overdue student loan payments starting May 5th for the first time since March of 2020. According to the department, over 5 million borrowers are currently in default, meaning they have not paid in 9 months. An additional 4 million borrowers are between 90 and 180 days past due. The department says just 40% of borrowers are up to date on their student loan payments. The Office of Federal Student Aid will notify all borrowers who are in default in the next 2 weeks. They are then expected to sign up for loan rehabilitation, apply for an income-based repayment plan, or make a payment. If none of those actions are taken, after 30 days, borrowers are subject to involuntarily being collected on through the Treasury offset program, including wage garnishment. Student loan advocates criticize the decision, with the Student Borrower Protection Center calling the move cruel and unnecessary. But the department said it plans to offer resources to borrowers, including an AI assistant, a simplified income-driven repayment application, and additional servicers' call times. Most Americans are currently saving money, or at least plan to save short-term, but 60% of them don't believe they've completely understood how interest rates impact their savings, and they earn under 3% on their money, according to a Vanguard survey. Meanwhile, most economists are anticipating higher inflation as tariff policies set in. That means millions of Americans will see the returns on their savings trail rising costs. That's why experts recommend high-yield savings accounts. Here to break down everything that you need to know about them is Gary Zimmerman, the founder and CEO of Max, formerly Max My Interest, a digital platform that matches people with banks to help them earn the best interest on their cash. Okay, so let's dive into this. Just first, why use a high-yield savings account?
Well, Brad, first of all, thank you for having me back on your show. We think high-yield savings accounts are essential, and the reason is very simple, which is they pay higher interest rates than a regular savings account that you might find at your brick and mortar bank. Now, this is really important because, as you pointed out, inflation is still at elevated levels, and if you're not earning at least the rate of inflation on your cash, you're actually losing real purchasing power each month. By contrast, high-yield savings accounts often pay higher than the rate of inflation, and so you can actually grow your money. And because of compounding, your money can grow and then grow on top of itself.
And so with that in mind, what are some of the pros and the cons of high-yield savings accounts versus what many people might be exposed to with just a regular savings account, perhaps?
Sure. Well, most people are accustomed to their existing brick and mortar bank, and we think those are really important, right? They provide all sorts of services. In addition to deposit taking, they also provide lending. They might help you with a home mortgage, a credit card. So your existing brick and mortar bank is valuable to you, and we're not suggesting that people should switch banks, but rather they should supplement that relationship with online banks that are able to deliver higher yield on the savings portion of their deposits.
So should somebody put all of their money in a high-yield savings account, or what's the diversification strategy among your accounts?
Well, we all need day-to-day money to live our lives, right? Our paycheck comes into the account, we pay our rent or our mortgage, we pay for tuition if our kids are in an independent school. So you need a certain amount of operating cash, and that typically sits in your checking account. But all the excess cash you have, maybe you're saving for a purchase, or pay for a kid's wedding, or for educational purposes. Maybe you want to build up an emergency fund so that you have 6 to 12 months of sort of operating living expenses in cash, that if you were to lose your job or some other catastrophic thing were to happen, you wouldn't all of a sudden have to sell equities and sell at the wrong time. So generally it's smart to keep a reserve, and that reserve should be in the highest yielding place possible.
How often should you be looking for better rates and kind of assessing what banks are offering the best rates that could be better than a high-yield savings account rate that you may have previously signed up for?
Well, it's a great question, Brad, because often people ask me, well, what's the best bank, right? Where should I open an account? Sure. And the answer is, it varies, right? Banks basically at some points need more deposits, and at other points in time they need fewer deposits. And so banks change their interest rates up and down to manage that supply and demand. And so what that means is that there's actually no right single bank account for you. We believe that you should open multiple high-yield savings accounts and then keep on top of rates. And whenever you see an opportunity to earn more, you can rebalance funds by moving them from one bank to another. And in fact, that's exactly why we built Max, to make that process really simple.
And so with that in mind, is there a different type of threshold that people should be prepared to have a conversation with a bank around if they're opening up a high-yield savings account?
Well, some banks, you always have to read the fine print, right? Sure. So some banks have minimums, or they'll offer a really high interest rate, but it only applies to the first $1,000 of deposits. That's kind of a teaser. It's the loss leader. Right. You want to look for someone who's going to treat you fairly, right? So one of the things we did on the Max platform is carefully curate the universe of banks, so there are no, minimum balance requirements, no monthly fees from the banks, and really no limits on how much you can keep at that bank and earn top yield.
Really good to know. Gary, thanks so much for joining us in studio.
My pleasure.
The current national average savings rate is 0.41%. That's according to the FDIC. With a high yield savings account, customers can earn up to 10 times more on their balances. Our very own Casey Bond joins us now with the top rates available at this moment. Casey, what have you found?
Yes, so even though interest rates are generally trending down, excuse me, we're finding that the best high yield savings accounts are paying anywhere from 3.5 to 4% APY and up, sometimes even more than that in some cases.
And so a lot of the top accounts come from lesser known online banks, which could give someone pause, seeing a name that they don't immediately recognize. What key things should our viewers look out for when researching an online bank to know it's legit?
Sure. So it's always a good idea to research a financial institution before you put money into one. One very important factor to consider is FDIC insurance. So most online banks are insured, but it's always a good idea to double check. Their fee structures should be transparent, easy to understand, and generally they should charge very few fees. Then security measures like encryption, multi-factor authentication, just making sure that they have those measures in place to protect your personal data. And finally, see what other customers are saying. You can look up reviews on the Better Business Bureau, the CFPB, and just see what kind of reviews and complaints are out there.
How do you choose between an online bank that might have a higher rate and perhaps a big known entity that may have a lower rate?
Well, that's really going to come down to your personal banking preferences. If you have a pretty simple situation and you're really just looking to get the best rates, online banks are a great choice. If you have a more complex financial situation, you prefer that hands-on, in-person banking experience, a larger physical bank may be a better choice for you.
Casey, thanks so much for taking the time, helping us break this down just a little bit more here on the high yield savings accounts and the decisions that many people are trying to work through out there. Appreciate it.
Thank you.
Certainly. Let's do a final check of the markets as we're taking a look at the major averages. We are up by more than 2% across the board right now, trying to erase some of the declines that we saw to start the week. Certainly, as we're taking a look at the Dow Jones Industrial Average, we got a little bit more work to do. We saw a decline of a little more than 900 points during Monday's trading session. As of right now, we're up by 800 points, 2% higher on the day. The S&P 500, you're seeing that higher by 2% as well. 103 points added there. The NASDAQ Composite, that's up by about 2.2%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. Plus, Yahoo Finance has special coverage of Tesla's earnings today, 4 p.m. Eastern Time. You do not want to miss it.